Usually when we talk about nearly $1 trillion, there's this expectation of something highly visible.
Right, like a massive tech company or something.
Exactly. A tech company or maybe a global automaker. You can physically see the phones in people's hands or, the cars idling in traffic.
Yeah, it feels tangible. The physical product kind of anchors the valuation in your mind.
Yeah. Right. You point at it and confidently say, there it is, that's the value. But then you step into the world of global asset management and, well, that visibility completely vanishes.
It's just entirely invisible.
Totally invisible to the average person on the street, yet it is literally the underlying plumbing keeping the gears of the global economy turning. So today, we are putting an X-ray machine up to one of these invisible giants.
And it is a giant.
It really is. And you brought us a single, incredibly dense source to decode today. This is the March 31st, 2026 Analyst Update presentation for Federated Hermes, Inc.
Yeah, I've been really looking forward to digging into this one.
Same here. Our goal for you today, listening, is to analyze the internal anatomy of a modern financial behemoth. I mean, how does a company founded in Pittsburgh back in 1955 navigate modern economic cycles?
It's a long time to survive in finance.
Right. And what do the internal mechanics of managing nearly $1 trillion actually look like?
This specific update is a brilliant diagnostic tool for that because it strips away the marketing language.
Oh, absolutely. No glossy brochures here?
Exactly. It forces you to look at the raw corporate physiology.
Right.
You see exactly where the capital sits and, more importantly, how the revenue is extracted.
So let's lay out the raw scale first, just to ground us. Federated Hermes is a pure-play asset management company. They operate with 2,089 employees. And as of this March 2026 report, they are sitting on $907.1 billion in assets under management.
Almost $1 trillion.
Okay, let's unpack this, because the very first thing that jumps out from their balance sheet isn't just the sheer volume of that capital.
It's the shape of it.
Yes, the peculiar shape. If you chart their asset distribution, it looks like a massively lopsided barbell.
That's a great way to put it.
On the smaller end, you have $222.4 billion in long-term managed assets. So, your standard equities, fixed income, alternative markets.
But stuff people normally think of.
Exactly. But then on the other end, acting as this massive counterweight, is $684.7 billion parked entirely in liquidity.
Which is just wild when you see it graphed out. But that structural imbalance is actually the defining characteristic of their survival strategy.
Really? A survival strategy?
Yeah, absolutely. Rather than looking at those billions as just static numbers on a spreadsheet, we have to look at the mechanical function of that lopsided barbell. It is engineered specifically to provide organic growth across wildly unpredictable market cycles.
Okay, well, let's pull apart that larger weight first, the liquidity engine.
Let's do it.
So they have that $684.7 billion in liquidity assets, which, by the way, actually grew by $2.1 billion just in the first quarter of 2026 alone.
A lot of cash moving around.
A ton. And the presentation breaks this down into $417 billion in government liquidity, $248.3 billion in prime, and $19.4 billion in tax-free. I look at this and honestly, I just see a massive checking account for the global economy.
Yeah, that's what it looks like on the surface.
But looking at it as a business model, if 75% of your AUM is just cash and liquidity equivalents, it kind of feels like operating a giant low-margin vault.
A vault.
Yeah, like you're just holding money, not necessarily investing it. So how is this an attractive foundation for a publicly traded firm? I mean, aren't they just sitting on cash?
What's fascinating here is that the whole low-margin vault idea completely mischaracterizes the mechanical reality of this capital.
Oh, really? How so?
Well, managing prime liquidity, for instance, isn't just locking cash in a dark room. It involves navigating the commercial paper market, buying short-term corporate debt from Fortune 500 companies.
Right, they have to put it to work somehow.
Exactly. They are continuously managing duration and credit risk on a massive scale. And government liquidity involves executing complex reverse repurchase agreements, moving hundreds of billions through treasury markets every single day.
So it's highly active, even if it's just cash.
Highly active. Massive corporations, global pension funds, sovereign wealth entities, they cannot leave their operational cash exposed to volatile equity markets.
Obviously. They'd lose their shirts if the market tanked.
Right. But they also can't afford for it to just sit totally idle and lose value to inflation.
Yeah.
They require a highly complex parking lot where the capital is shielded, still earns a competitive yield, and remains instantly accessible for their own operational needs.
And the regulatory and, the technological barriers to operating a $500 billion institutional parking lot have to be astronomical.
Oh, they're huge.
You don't just, spin up a startup in your garage to handle global commercial paper clearance.
No, the infrastructure required is immense, and that creates a massive economic moat. But the metric in this presentation that really proves the durability of this engine is the long-term performance.
Okay, hit me with the numbers.
If you track the money market fund assets of Federated Hermes from December 1993 all the way to March 2026.
That's over 30 years.
Yeah, a long time. The compound annual growth rate sits at 9%.
Wait, 9%. So that means they maintained a 9% annualized growth rate on cash management through, what, the dot-com bust?
Yep.
The 2008 financial crisis? A decade of zero interest rate policy and the recent inflation spikes.
A 30-year gauntlet.
That is wild.
And here's the kicker. Over that exact same 3-decade period, the broad S&P 500 index growth was also 9%.
You are kidding.
No, it's true. Their core liquidity business has matched the annualized pace of the U.S. stock market. It acts as this compounding, unshakable foundation for the entire firm.
Wow. Okay. But surviving a bear market with liquidity doesn't necessarily solve the problem of a bull market. A massive checking account, even a highly complex one with a 9% CAGR, doesn't generate the profit margins needed to drive aggressive corporate earnings growth.
Right, the fees on cash are tiny.
Exactly. Which naturally pushes us to look at where the firm actually makes its money. We have to shift our focus from the raw volume of the assets to the mechanics of their revenue generation.
And this is where you see the internal hedging mechanism of the business model activate.
So let's look at the numbers. The Q1 2026 update reports total revenue at $479 million, bringing earnings per share to $1.27.
Solid numbers.
But the Analyst update highlights a far more critical metric for understanding their profitability, which is total revenue less distribution expense.
Which is key.
Yeah, because by stripping out the platform fees and the payouts to the brokers selling their funds, we see the pure management fee retention.
Exactly, what they actually get to keep.
Right. And that retained revenue has more than doubled. It climbed from $160 million in the first quarter of 2014 to $353 million in the first quarter of 2026.
The growth trajectory is definitely strong. But the internal composition of that revenue tells the real story of their evolution.
Yeah, the pie chart has undergone a massive internal rotation over the last decade. In Q1 2014, money market, that giant liquidity bucket we were just talking about, drove 47% of their total revenue.
Almost half.
But by Q1 2026, even though the sheer volume of liquidity assets grew significantly, the money market's actual share of the revenue pie shrank to 36%.
A noticeable drop.
Meanwhile, fixed income revenue climbed from 15% to 21%, and equity revenue now commands 22%, with alternative, private markets, and multi-asset strategies capturing the remaining 21%.
So the barbell reviews its purpose.
So what does this all mean? The paradox of their balance sheet is glaringly obvious when you map their assets to their revenue.
It's completely inverted.
It really is. Liquidity holds the overwhelming majority of the capital, nearly $685 billion. But the long-term assets, the $100.8 billion in equity, the $99.8 billion in fixed income, the $19 billion in alternatives.
The smaller side of the barbell.
Right. They are generating the lion's share of the actual profits. Roughly 2/3 of their revenue is being extracted from barely 1/4 of their assets.
It's a beautifully engineered corporate structure. It's truly weatherproof.
Weatherproof how?
Well, let's trace how this operates across an entire economic cycle. When the global economy is expanding and equity markets are roaring, institutional investors pull their capital out of low-yield liquidity.
Because they want better return.
Exactly. They deploy it into higher risk, higher reward equity, and alternative strategies. And those long-term funds carry significantly higher management fees.
Okay, I'm following.
So during a bull market, even with a smaller total asset base in those buckets, Federated Hermes captures massive margin expansion and revenue growth.
But when the cycle inevitably turns and, a macroeconomic shock hits...
Institutional panic sets in. Clients liquidate their equity positions, which immediately contracts revenue on the high margin side of the business.
Right, the fees dry up.
But that liquidated capital doesn't just evaporate. It requires an immediate safe haven. So where does it go?
Oh,
It floods directly back into Federated Hermes government and prime liquidity funds.
Oh, I see.
The margins on liquidity are significantly tighter, sure, but the sheer overwhelming volume of capital pouring in acts as a stabilizing floor for the firm's overall revenue.
That is brilliant.
The business essentially acts as a counterweight to itself, monetizing both the risk appetite and the systemic fear of his client base.
Wow. But there is a catch here.
Huh?
To convince institutional investors to pay those higher active management fees when the economy is roaring, they have to prove they can deliver something a zero-fee Vanguard index fund cannot.
That's the billion-dollar question.
Right. The existential threat to every legacy asset manager is the relentless rise of passive investing. If a client just wants generic beta exposure to the S&P 500, they aren't paying Federated Hermes a premium to manage it.
No, they'll just buy an index fund.
Yeah.
A firm in their position has to relentlessly justify its fee structure through active evolution. They meet highly specialized capabilities that cannot be replicated by a passive algorithm.
Which brings us to the source's breakdown of their active strategies. The presentation outlines a highly aggressive push into the active ETF space.
Yeah, they've been busy there.
They launched the Total Return Bond ETF in January 2024 and rapidly scaled it to $531.3 million. Following that, they rolled out the MDT Large Cap Growth ETF in July 2024, which already sits over $405 million.
Fast growth.
Yeah. They are basically taking their proprietary active management algorithms and packaging them inside the modern, tax-efficient ETF wrappers that financial advisors demand today.
It demonstrates necessary structural agility. The mutual fund wrapper is facing severe headwinds right now.
People are definitely moving away from them.
Right, and rather than clinging to a legacy distribution model, they are migrating their core intellectual property into the vehicle the market actually wants to buy.
But the truly unique capability detailed in this report isn't a new fund wrapper.
No, it's something much bigger.
The source dedicates significant space to a division called EOS at Federated Hermes. And the metrics surrounding this division are staggering.
They really are.
Because while the firm directly manages $907 billion in AUM, this EOS division operates with $2.3 trillion in assets under advice, or AUA.
The functional difference between managing assets and advising on them is the key to understanding their global influence.
Let's establish the structural facts of this division based on the presentation. EOS is their global stewardship and responsible investment arm. They possess 22 years of proprietary engagement records. In 2025 alone, this division engaged with approximately 900 unique corporate issuers.
That's a massive footprint.
And this team isn't just comprised of traditional financial analysts. It is a 60-plus member global unit heavily staffed with scientists, corporate governance lawyers, and climate risk experts.
That's a very specialized team.
Now, just to be completely clear for you listening, we are analyzing this EOS division purely as a factual business capability offered by the firm. We aren't exploring the political or ethical debates surrounding ESG investing.
Right, we're just looking at the mechanics.
Exactly. We're examining how Federated Hermes wields this division as a massive commercial differentiator.
And from a purely strategic standpoint, it is one of the most sophisticated value adds in the institutional space.
Here's where it gets really interesting. Reading through the mechanics of an EOS engagement, they have essentially built an activist immune system for massive institutional investors.
An immune system, I like that.
Yeah, think about it. Imagine you are a massive European pension fund. You are legally obligated to ensure the hundreds of global companies in your portfolio aren't harboring hidden supply chain liabilities.
Or corporate governance risks.
Right, or unpriced climate exposures.
Right.
But you physically do not have the internal headcount to actively monitor 1,000 different corporate boards.
Nobody does.
So what do? You outsource that function. You hire the EOS team. You are renting Federated Hermes scientists to act as white blood cells, hunting down risks before they impact your portfolio's performance.
If we connect this to the bigger picture, the scale of the soft power this division generates is almost unfathomable.
Unfathomable.
Think about the leverage of that $2.3 trillion in assets under advice. When the EOS lawyers and scientists secure a meeting with the board of directors of a major global automaker or a multinational mining conglomerate.
They aren't just representing the $907 billion Federated Hermes manages directly.
Exactly. They walk into that boardroom wielding the proxy voting power and the collective voice of $2.3 trillion worth of global capital.
Wow. It gives them the leverage to demand supply chain transparency or executive compensation audits that a smaller, passive manager could never achieve.
Never.
It's a massive multiplier effect on their institutional influence.
And it embeds Federated Hermes deep into the operational fabric of their clients, particularly across Europe and the UK.
The numbers back that up, too.
Yeah, the presentation notes they have $27 billion in direct assets under management in the UK and Ireland. But by providing this bespoke stewardship advice to massive funds across the continent, they cease to be a replaceable vendor selling a bond fund.
Right, you can replace a bond fund easily.
But you can't easily replace an indispensable regulatory and risk management partner. It is a highly engineered economic moat that passive index providers simply cannot replicate.
So we've mapped out the internal plumbing here. We have the liquidity bedrock acting as a hedge against market crashes.
Yeah.
And we have the high margin active management and EOS advisory divisions driving revenue growth.
The two sides of the barbell.
Exactly. So the final step in evaluating a legacy financial giant like this is examining the actual mechanics of their corporate treasury. Basically, what do they do with the massive amounts of cash this whole machine generates?
Which is the ultimate test. Capital allocation is the ultimate litmus test for executive discipline.
Well, the historical timeline provided in the update is remarkably consistent. Since their initial public offering in 1998, they have returned a total of $6.9 billion to shareholders.
That's a huge sum.
And the proportional breakdown of that deployed capital is highly revealing. 45% has been distributed as dividends,
Okay.
36% used for share repurchases, and only 19% allocated toward acquisitions. And for the first quarter of 2026, they declared a solid dividend of 34 cents per share.
The overwhelming priority there is flushing the profits directly back to the owners of the enterprise, rather than just hoarding it on the balance sheet.
And when they do deploy capital for M&A, the timeline shows a total rejection of those massive headline-grabbing industry mergers.
Right. No ego-driven buyouts.
Exactly. They favor highly targeted bolt-on acquisitions. They purchased Clover Capital Management in 2008 specifically to acquire value equity capabilities.
Filling a gap.
Yep. They bought a 60% stake in Hermes Fund Managers in 2018 and eventually acquired the whole entity explicitly to capture that massive EOS stewardship franchise we just talked about.
Very strategic.
And in 2022, they acquired C.W. Henderson to instantly bolt on highly specialized municipal bond expertise.
They utilize acquisitions to buy specific, missing tools for their workbench rather than trying to buy out the entire hardware store across the street.
Which makes sense. But if I'm looking at this as a business case study, why prioritize dividends and share repurchases, which, again, account for 81% of their historical cash use, over aggressive competitor acquisitions?
It's a fair question.
I mean, wouldn't an asset manager currently sitting on nearly $1 trillion want to leverage up and buy its way to $2 trillion to capture economies of scale?
Well, this raises an important question about the life cycle and survival rate of legacy financial institutions.
Yeah.
How does a company founded in the 1950s avoid obsolescence in the 2020s?
By adapting, I assume.
Yes, but the financial sector is literally littered with the corpses of asset managers who attempted to buy their way to scale through massive trend-chasing acquisitions.
Oh, totally. We see it all the time.
The mechanical reality of those mega mergers is usually disastrous. The acquiring firm overpays, they take on toxic levels of debt, the disparate corporate cultures violently clash.
The star portfolio managers inevitably resign.
Exactly. And then the institutional clients immediately pull their capital.
The classic empire building trap. You buy bloat instead of capability.
Federated Hermes' capital allocation strategy is the manifestation of a highly disciplined, pure-play philosophy. They understand the precise mechanics of their own barbell model.
They know who they are.
They survive by refusing to over-leverage. They identified that European stewardship was going to be a critical future requirement, so they acquired Hermes. They recognized a gap in high-net-worth municipal bond offerings, so they bought C.W. Henderson. They seamlessly integrate those highly specific teams into their distribution network, and then they take every remaining dollar of excess cash and return it to the shareholders.
It's remarkably simple when you lay it out like that.
It lacks the dramatic flair of a multi-billion-dollar hostile takeover, sure, but it is structurally bulletproof.
It really requires the profound corporate discipline of knowing exactly what your firm is good at and ruthlessly avoiding what it isn't.
Institutional humility is a rare and highly profitable commodity.
Absolutely. Well, let's synthesize all of this for you, the listener. We've extracted a tremendous amount of mechanical data from this March 2026 Analyst Update.
We really have.
Whether you are prepping for a strategic finance meeting, mapping out broad industry trends, or you are just deeply curious about the invisible machinery that manages giant pools of global capital, the core takeaway from decoding Federated Hermes is clear.
What's the bottom line?
In modern asset management, scale alone is not a strategy. Balance is the strategy.
A very deliberate, mathematically sustained balance.
Exactly. It is the relentless maintenance of that barbell. On one side, they operate a massive, low-margin, high-volume liquidity engine that functions as an impregnable bedrock during macroeconomic panics.
A shock absorber.
And on the other side, they deploy highly specialized active management to extract premium margins during market expansions. And they wrap that entire structure in a layer of global advisory influence that embeds them into the operational core of their institutional clients.
That elegant system.
They haven't just figured out how to survive economic volatility. They have engineered a corporate physiology designed to actively monetize every single phase of the cycle.
And looking at the sheer scale of that advisory influence leads to a really fascinating inflection point for the broader industry.
Ooh, where do you see it heading?
Well, we established that their EOS division is advising on $2.3 trillion. That's more than double the actual capital the firm holds in its own accounts.
Right.
So as algorithmic passive index funds inevitably drive the cost of pure market exposure down to zero.
Which they are doing.
Could the future of legacy asset management look less like physically holding people's money and increasingly like selling the elite intelligence, the scientific analysis, and the proxy influence required to watch over it?
A shift from the value of the vault to the value of the advice.
Exactly.
That is a brilliant pivot to consider. And we're going to leave you to mull that one over. Thank you for joining us for this custom-tailored deep dive into your sources. We've taken the incredibly complex machinery of a trillion-dollar asset manager and hopefully made the invisible plumbing a little bit more visible. Until next time.